was the market starting to price in these auto import tariffs?
No, I mean, which is why it's a little bit of a surprise that they reversed on that news. I mean, really, it wasn't a headline because they hadn't made any real decision on it. Now, that being said, they've delayed it, but that just means that we've got to deal with it another 6 months. So for us, probably the biggest takeaway is there will be uncertainty for some time to come.
And maybe, Steve, it helps to put it in context of what that kind of move, if the president were to go through on the auto import tariffs, would do to the economy. I mean, this could be a pretty big hit, right, Steve?
Potentially, Sarah, but I kind of get the feeling that Wall Street is coming to terms with the idea that tariffs are here, they're here to stay, and that you can count on there being more tariffs rather than fewer tariffs in the months ahead. You'll notice, my understanding is the Canadian and Mexican tariffs have not even come off, despite the fact that there is a trade agreement. So the appearance this administration gives, and this is something I think that's a little Jekyll and Hyde here, is that on the one hand, these tariffs are a negotiating tool. On the other hand, there's this idea that we've talked about for the past, several months or so, that maybe the administration wants a permanent tariff regime in order to protect U.S. industry. So, and I think Wall Street's beginning to sort of understand that idea.
Yeah, and there's also this debate, Samir, about just how afraid of tariffs we should all be. I mean, there's no disputing in economics that tariffs are taxes and they hurt growth. But they hurt growth in other places more than they hurt growth in the U.S. So how should investors take all this news?
Sure. So we've got a little bit of a barbell approach where we would, again, continue to probably take most of our bets on the emerging market equity side. You know, we do think eventually there probably is a trade deal. Now, it may not be the grand bargain we were all hoping for, but there probably is some type of short-term deal. Both sides have a heavy incentive to try and get something done. The tricky part is on the other side, you've got U.S. small caps, which are kind of struggling a little bit because the U.S. economic cycle is maturing. So we're playing a little bit of a barbell. And then we also like cyclical sectors. So think technology, financials, industrials, consumer discretionary energy. We like all of those.
Yeah, and it also raises a question, Steve, about when, if at all, it does impact the data on top of some unexpectedly weak data that we got this morning.
Yeah, so, I mean, I think it's already in the data, and the idea is that maybe other data, the other strength has sort of papered it over or otherwise made it harder to see. There's little doubt that if you raise prices on something, you create a cost there that somebody is bearing. You've had a lot of noise in the data because of the tariffs. For example, some quarters where we get huge amounts of imports as importers try to get ahead of the coming tariffs. Sometimes you have right now, you have the industrial production data that fell in part because some economists think that we're working off the inventories that were bolstered up or boosted up in the first quarter because of the tariff. So a lot of noise in the data to try to figure out exactly how it's affecting. But you raise prices, you're going to otherwise hurt growth and take spending away from other places. And who knows, maybe some of the weakness in the retail sales number might reflect that today.